This one is presented a little differently, okay? This is a different look. You're just given some facts about the company, okay? So you're not given the financial statements directly. This is actually in some ways easier. They're just giving you the exact piece of information you're going to need to do it, okay? But it's a different like take on compiling it, okay? So really, what you should be able to do is take the financial statements and then compile this set of facts for yourself. And then once you have the set of facts, you can make the statement of cash flow. But they're kind of just giving you the list without the financial statements. So try to piece this together. You will have everything you need here to do the statement of cash flow, all three sections. But you're going to have to do a little like, investigative work to see which part of this information fits where. Okay, so we'll test your understanding of what the three sections are and what information is included in each of them. Okay, so try to do this, and we'll kind of do it together later. Okay, so I'm just gonna go step by step. Now, uh, it is possible to do an ongoing kind of accounting of cash. I'm gonna do a little hack because I know assets equals liabilities plus equity. And I'm going to be able to solve for everything in this, all the assets, all the liabilities, all the equity accounts, except for cash. And so if I have that, I'll be able to use the accounting equation to solve for what cash needs to be to get the balance sheet to balance. Okay, because there's so many transactions that are happening with cash. I don't want to have to kind of keep altering it. Okay, so let's just go step by step. So on January 1st, we issued common stock for $525,000. So I know that it affects cash. I'm just going to do uh, the half of the journal entry pretty much by updating the equity section with common stock. 525,000. Okay. So now this first one is accounted for. Second, early in January, we made the following cash payments. So again, these are all affecting cash too. They're all outflows, but I'm going to, again, not worry about cash for now. Um, why don't we do this? Let's just do a little T account here. Let's see if that, uh, I can do it two ways. We'll do it two different ways. So I have my T account here. So the first one was the inflow of cash, 525,000. The second one is outflows, 55,000, 320,000, and 17,000. Okay, so I'm also going to put these on my balance sheet. So store fixtures, 55,000. So these are all assets. And I'm going to have a section for long-term assets and one for current, of which cash, inventory, AR, okay? And this one is fixtures, 55,000, okay? And then another one is merchandise inventory, 320,000. So inventory, 320,000. And then third, we had rent expense, 17,000, okay? So this is something that's going to go on what income statement? Or sorry, it's going to go on the income statement. Sorry, I just told you the answer. So this is not on the balance sheet. Again, this is why I'm saying this problem is a really good test of your understanding of how transactions relate to the financial statement. So this is going to be on our income statement. So I'll have a place for revenue here, and then we'll have expenses, of which we'll put rent expense, 17,000. Okay, and then so all of those three are accounted for as decreases in cash. So this is done. Okay, later in the year, we purchased merchandise inventory on account for 244,000, and before year end, we paid off 164,000. Okay, so I know cash going out is 164,000 because we paid off those accounts receivable with that. What is my ending balance of account receivable? I had 244,000. I paid off 164,000. So I have 80,000 in ending balance of accounts payable. Okay, so I'm going to go to my balance sheet. I'm going to go current liabilities, accounts payable, 80,000. We have both the cash and we have the accounts payable all squared away. Next, during 2025, we sold 2,500 units for $400 each. So what is this information on? What is this telling me? Revenue. Exactly, revenue. This is all related to revenue. So I'm going to go to this sales revenue and I'll just do the math just in the cell with using Excel. 2,500 units times $400 per unit. $1 million of revenue. Okay, what else did it tell us? So we initially sold all of this on account, but we collected 85% of it. So that means, what is my ending balance of accounts receivable? Well, first let's do this. How much cash did we collect? It was $1 million. Exactly, times 85%. 850,000 incoming. Accounts receivable is basically the remaining 150,000. Okay, so I go to my balance sheet. 150,000 is accounts receivable ending balance. So this one is done. Oh, actually, hold on. We didn't finish. Cost of goods sold for the year was 320,000. So what I did not do here, okay, I forgot to do this from one of the last transactions. Remember, we bought 244,000 on account. Does everyone remember that? Okay, so I'm going to add that. Okay, but now it's also telling us our cost of goods sold was 320,000. So I have to subtract, because remember, the journal entry for cost of goods sold is cost of goods sold, which is an expense, which again, I'll have to put on my income statement, 320,000. This is chapter 5. What was the credit for cost of goods sold? Debit the expense, cost of goods sold, credit inventory. Yes, inventory. So that's a reduction in this asset, right? Because we're now sold these inventory items. So I have to go to my inventory. And again, that's why I got this minus 320,000, because that's my cost of goods sold. So now our ending balance for inventory is complete. It included the cash purchases of 320,000. It included the credit purchases of 244,000, and it included the cost of goods sold that was outgoing inventory of 320,000. Okay, and so I'll also add here cost of goods sold, 320,000. Okay, so now I've completed this one. I've completed this one. Okay, everything is now accounted for in these. Okay, the store employs 3 people. The combined annual payroll is 80,000, of which HRC still owes 3,000 at the end of the year. So how much cash did I actually pay my employees? 77. See, so you can see how the salaries payable liability is related to cash flow. It's a negative adjustment. Okay, so current liability, salary payable, 3,000. And then we had salary expense, 80,000. So when I said negative adjustment, I misspoke, okay? What it means is that cash flow is less than the expense. But that's going to mean we need to do a positive adjustment to net income, because net income is subtracting 80,000, but really the cash flow is only 77,000. So we need to add $3,000 back. That's going to be the adjustment. We'll see later. Okay, so we have this expense of 80,000. We have the salary payable liability of 3,000. So this one is fully done. But this we need to have 77,000 outgoing cash. Okay, at the end of the year, we paid income tax of 20,000. There's no income tax payable. So that means, how much of it did we pay with cash? All of it. Okay, this is all fully $20,000 out the door for income tax. And we have an expense called income tax expense, 20,000. So you can see there's no adjustment for this. This $20,000 expense, which is baked into net income, it requires no adjustment for cash flow because it's a fully cash expense. Our income tax payable was 0 at the beginning of the year. At the end of the year, income tax payable is still 0. That's why there's going to be no adjustment for that. We paid a dividend, 39,000. Okay, so we'll wait on this one because I want to do retained earnings first. Okay, so we'll wait on this one, but at least we'll subtract the cash. Okay, 39,000. Okay, so this one is like half done. Okay, so I'll put a little question mark here. Okay, so for store fixtures, HRC uses straight line depreciation method over 5 years with 0 residual value. So how should I calculate the depreciation expense? Since it's straight line, I take the cost basis minus the residual value, which is 0, divided by 5 years. So it's $11,000 per year. So I will have depreciation expense, 11,000. And what else do I have to do? This is going to be my debit. What's my credit? Accumulated. Okay, so I'll do this. Accumulated depreciation, negative 11. And of course, cash is not affected by that. I think we're pretty much done. This is wrong. There's something that we're missing, but let's just see where we went wrong. Okay, so net income is equal to revenue minus the sum of all this. Okay, so that's correct. Let's see what our total assets are. Well, let's do the liabilities first. So this is total liabilities, this plus this, so 83,000. Our retained earnings, so our beginning balance is 0, plus our net income, minus our dividends, which was 39,000. Okay, that's going to be our ending balance. This is retained earnings. I think I know what we did wrong. If I go up here, I know it's 39. Okay, let's see. Let's continue and see what number is off. So our total equity, okay, so our total liabilities plus equity is equal to this plus this. Okay, so that is right. Okay, so everything is right here. Let's okay, so one way to do it is to basically get your current assets, or sorry, your total assets exclusive of cash. So right now our total assets is equal to this 44,000 plus this. So right now we are short. If we want our accounting equation to balance, we need $683,000 more assets. And that is the correct amount for cash. Okay? So now, just to prove what I'm saying, if I add up all my assets, which is this plus the sum of all this, you can see that my assets equal my liabilities plus equity. Okay, so this is actually the correct balance sheet. Now, what we did wrong here, let's pause and think about it. I'm going to pause and think about it. I want you all to move on to the statement of cash flow. Okay, so remember, start with the operating section. Okay, you're going to start with net income, which you now have. Okay, you're going to do a depreciation expense add back. Were there any gains or losses from the disposal of assets? No, we saw the transactions, nothing there. Then you're going to do adjustments for change in current assets and current liabilities. And the change is all going to be based on starting balance 0 and then what the balance is now, because that's the change. The starting balance was 0 for all the current assets and current liabilities. This is the first year the business has existed. Okay, so the changes will just be kind of the ending balances since the starting balances were 0. Okay, so try to make this section work, and we'll do it together in a second. I'm going to try to figure out what happened to the cash. Okay, so just to clarify, the formula just was not, it was kind of blocking. Maybe I can insert some rows here. If we look at the formula now, it is including the dividends. It was just not including, it was like this before. That's why it was $39,000 off. But when we included all the credits, it turns out to be the same. Okay, so operating section. We start with the net income, and that we already calculated in this income statement. So I'm just going to do a cell reference. Depreciation expense, that's an add back because again, this is a non-cash expense that's already baked in here. This net income has that expense in there. And so we know that's not cash. So we're going to have to, the goal of this again is to take net income as a starting point and adjust it to get how much cash is actually baked in there. Okay, so we need to add back depreciation expense because we know it's definitely nothing to do with cash. Okay, so we're going to add that back. Okay, so now we have to remember our rules for changes in these current assets and current liabilities. Now, again, all of these are increases because we started at 0 in the beginning of the year. Okay, so increase in account receivable, that is a negative adjustment to cash because it's a current asset. Increase in inventory is also a negative adjustment because it's also a current asset. So I'm just going to do like equals negative sign, cell reference to accounts receivable, equals negative sign, cell reference to inventory. Increase in AP is the opposite because it's an increase to a current liability. It's going to be a positive adjustment to cash. So I'll just do a cell reference to that. Same thing with salaries payable. It's a current liability increasing. Okay, so now all I have to do is add all of these up. I'll just give you a hypothetical here just to show you that each of these is done independently, but they all are related. So for example, let's say I bought inventory of 244,000, which is a negative adjustment because it's a current asset going up. But let's say I financed it all with accounts payable, right? So there's no cash that was transacted to buy the inventory. This increase in inventory would be offset by a 244 increase in accounts payable. So that would have been, just hypothetically, if I just bought inventory 244,000 on credit, yes, I would have had this negative adjustment for cash. But then it would have been totally offset by a positive adjustment in accounts payable. Okay, so though we're looking at each one individually and making adjustments, since they're related, you're just knowing that they're going to offset. Okay, if they were related, like for example, you bought inventory with accounts payable, because there's no cash that was transacted there, right? So you would expect that there would be no net adjustment to cash because that whole series of transactions was not involving cash at all. And you would see that happen with two offsetting adjustments. Okay, so now you got to kind of trust this process of these adjustments working on a net basis, and they do. Okay, what was the one transaction made for investing? So we bought purchase of fixtures. That was a negative 55,000. That was the only investing activity. What about financing activity? Yeah, so we had issuance of common stock. So issuance of common stock. What else? There's one more. Yes, dividends, payment of dividends. Okay, so issuance of common stock, positive or negative influence on cash? Positive, right? We raised money. We brought in cash by selling stock. And this, of course, was negative. We're paying cash out to shareholders. Okay, we have a total change in cash flow. You just add up the three sections. This plus this plus this. And it's exactly equal to our balance sheet amount because our starting balance of cash was zero. So we went from zero to 683,000. Okay, so in the next period, we're going to reconcile 683,000 to whatever the ending balance is. Okay, but in this case, since it's the first year of the business, which again, it's stated here, historical rare coins was formed on January 1st, 2025. Okay, so that's how we knew that our starting balances were zero. This is why this chapter is really hard, because you have to tie together so many different things.